Yes, a very good morning, everyone. Bangalore Valuers Association welcome the participants. BVA, in its pursuit to quench the knowledge thirst of its members, is presenting today's session on demergers and common control mergers. I would like to bring to the attention of everyone that earlier we had in mind another session, but unfortunately that speaker had certain emergency and they could not make it up. So thanks to Mr. Visheh for accepting BVA's last minute request to have this session. Thank you, Vishesh, for this. Kusum, now I request you to formally introduce speaker for our audience.
Thank you very much, Shilpa, for this privilege. I am very pleased to introduce Mr. Visheh Unni Raghunathan. He is a very young and experienced professional, which is actually a very, very rare combination. He has over 9 years of experience in practice, consulting, as well as teaching. He is adept at mergers and acquisitions, valuations, as well as fraud investigations and due diligences. He is a chartered accountant. He's a cost accountant. He is also a CGMA, ACFE, as well as a registered valuer. He has innumerable qualifications and memberships, which I'm very, very proud to announce. He is an associate member of the Institute of Chartered Accountants of India. He is a certified fraud examiner. He is also he has a certificate on alternate dispute resolutions by ICAI. He has a certificate on anti-money laundering from ICAI. He also has completed his certification course on forensic accounting and fraud detection from ICAI. More importantly, he is currently pursuing PhD from IFMR GSB, which is Kriya University. He is also a co-opted member of MSME Committee of Hindustan Chamber of Commerce. He is a visiting faculty for FinTech at MOP Vaishnav College, Chennai. He is also developing accounting courses for an online platform. He is a visiting faculty for finance and costing with IGTC. He's a co-founder of BookRack India. He's a director at Fat Rhino Tech, a boutique consulting and advisory firm. It is with immense pleasure that I welcome him this morning. He has actually completed valuations in various sectors, which is cement, estate, logistics. He is also involved in M&A valuation for a group in various parts of the country. He is also handled due diligences and forensic audits. He is also an adept at audit and assurance services. So welcome, Mr. Visheh Unni Raghunathan. I believe that it is important that we have a fair understanding of valuations, particularly when India is actually playing a very significant role in contributing to the fast-paced global economy. There are mergers and acquisitions that are happening, as well as demergers that are happening. So it is very important for us to understand what are the nuances when it comes to accounting and valuation in such situation. Thank you so much for accepting our request at a short notice, and over to you, sir, for your deliberation.
Thank you, ma'am. Good morning, everyone. Glad to be speaking at BVA again. So today I'm going to be talking about a very specific topic, which is common control transactions. So mergers and demergers, usually demergers tend to be common control transactions. There are cases where it need not be. That's an exception, but usually we see that they are common control transactions. So I just when I was requested to take up for some topic, I just felt this is something at a short notice. I felt this is something which this is important for a lot of valuers to know. What are the circumstances we can do common control valuations? What are the documentation we should do? And what we need to ensure that are in place, and the tests we need to do to allow or to certify a merger or a demerger under common control transaction. What are the issues we will face if we are going to be doing this? More importantly, we can use whatever valuations we do. Ultimately, there is a regulatory impact also on anything we do. So in terms of documentation, what are the regulatory issues we can face, or what is the whether a minority shareholder can claim something against us, etc. So these are the areas we'll be looking at today broadly. I also want to I'll also try to try and give some idea or concepts from the academic side of valuation as and when which is there, which is a very far more different field than our practitioners side, right? So the second you go over there, the conversation is on entirely different way of looking at things. But the perception of valuation or the perception of value on how analysis is done is entirely different from our practitioner side and what is there in our valuation standards. Having said that, the valuation standards are themselves based on the research on the academic side. So there is obviously a feedback loop, but the time between what happens in academia and what happens in the valuation standards, there is a lag. And how and what is the underlying concept is something which we as valuers do not think about too much. But specifically to today's topic, I will try to touch upon few of the aspects which are over there. Right? Uh, yeah, okay, I think I can share my screen. One second, let me just. So at the outset, this is not a very difficult topic in terms of what is going to happen, what we are going to be discussing, or how the valuation is done. As a we are talking about common control. So the entire crux of the conversation is if there is common control, I can show common control. If there is no loss to minority shareholders, I can do the valuation under book value and merge the companies. That's it. That is all I'm going to be talking about today. But we will look at how or why we can do this, right? So the part is this is what is going to happen, but what are the legal backing for this? What is the accounting backing, accounting standards backing for this, and how does taxation look at this? These are the aspects which we will be covering today. Now, we are talking about India growing and all of those things, but one of the most interesting things in the recent years is the amount of regulatory changes which has come in terms of GST, in terms of how Companies Act has been amended, in terms of the SEBI regulations being brought out. So all these various things are there. Now, at the with under this light of change in compliance environment, under the various provisions which have been brought in, what has happened? There are a lot of concerns in India, usually family concerns in India, family and friends concerns in India, where the owners or the promoter group owns multiple entities. So over a period of time, over many, many years, these entities were formed for various purposes. It could be for tax planning, it could be for various getting some benefits in different states. So many other reasons are there, or just because they're having some minority in some company along the way. These sort of issues are there. But what has happened is that in today's environment, we cannot, it is becoming costly to operate multiple entities for the same purpose or for allied purposes. So there's an overwhelming need felt in terms of bringing all of them together in terms of a merger. The other side of it is true when you're talking about demergers, where I'm a company, I want to demerge and spin off, where I now am looking to slowly give up control or control it separately or have certain investments and other things come in, right? And where it's going to be more like a joint venture or there are funding only for one aspect of the business, etc. So that is the case with demergers. So the evolving business scenario says that allows us or brings us situations where these sort of transactions have to happen, not just for large multinational groups or large groups of businesses, even Indian businesses, but even for very small balance sheets, right? So it's not that we are looking at even a scenario for small companies. We are looking at scenario for various companies. Recently, I found a demerger exercise for a small company again through the RD process. So it is there. It's not that the balance sheet was very big. The turnover I think was around 5 crores or so, but it was a family dispute and they were splitting the assets into two. So when they were having to split all the assets, one of the assets was a company which obviously owns land and building. So how do you split it and what do you do? It's a larger scheme on how you work out the settlement process, which is done. So these are the scenarios we'll have in terms of I can give you an example in terms of mergers where there were multiple. I think this was what I spoke about last time in BVA, where there were one group at 25 companies. Of that, we wanted to merge 13 companies. So we went under the common control principle, saying that ultimately the entities are all controlled by the same individuals or companies controlled by those individuals again. And since there is no loss of control within the group, we were able to do a common control merger for those and not do a fair valuation merger. So, in a nutshell, uh, to put it, we are looking at scenarios where I don't do fair value and I do book value. So, these are cases where the audited financials are drawn, and based on the audited financials, we arrive at certain basis and we merge or demerge the entities. So for our convenience of discussion today, what I'm going to do is I'm going to first I'll cover some of the provisions of Companies Act which enable both the transactions, and then we will look at mergers deeper, and then we will look at demergers. One important aspect is that under Companies Act as such, there is no distinction or distinction between mergers and demergers, right? Ultimately, everything is a scheme of arrangement under Companies Act, under 230, 232 of Companies Act. Everything is a scheme of arrangement. Whereas, on the other hand, Income Tax Act differentiates between mergers and demergers. There's a clear focus in Income Tax Act on the conditions to be satisfied for merger, conditions to be satisfied for demerger. I think we'll all agree ultimately mergers, demergers, and these sort of transactions are the ultimate focus or vision there is to look at the taxation impact, right? Yes, we talk about value, we talk about value unlocking or uh, whatever other terminologies we like, synergy benefits, all of these things which we talk about from the valuation practitioner's perspective. But ultimately, if you look at the end goal of the people involved in the transaction, one of the key goals, if not the main goal, one of the key goals always is tax benefits. So it is necessary as valuers that we understand the taxation side of how these aspects work and where do they fit in terms of what we are going to do. Ultimately, two important things to be fulfilled in any merger or demerger transaction from our perspective. One is valuation, second is the accounting treatment. Ideally, this particular accounting treatment has to be done by the given by the chartered accountant of the company or a CA certificate to be given. But most often than not, they also come to us for recommendation because we are the ones who are advising on the transaction or who have gone through the transaction in detail in terms of structuring and restructuring. So the question will come, are there any reserves which we need to account differently? How do we bring how do we account for the assets? How do we, what happens to the liabilities? What happens to the reserves? What happens to, mutual transactions which are there between the entities? So these are all questions which usually we end up answering, and we have to give the accounting backing for any of these questions asked. Uh, so I will cover those aspects as well. I will talk about how to look at those aspects as well. Let's
Vishesh, you will
just
be adding that in your report or just you share the information with the company?
No, I don't add that in my report, but usually where this comes is it comes in the scheme document. So general practice which I follow in any merger or demerger, I get a copy of the draft scheme from the company and have it with me. And in the scheme, I go through the accounting treatment also given, because if if I'm doing a valuation with a certain perspective, in the accounting treatment or the overall the way the scheme is configured, and then the subsequently the accounting treatment within it is contrary to my valuation report or to the intention of my valuation, then at some point a conflict will arise and the transaction cannot go through. So usually I review the scheme document once, even if not going through the nitty-gritties and details, what are the usual clauses, etc., which different secretarial teams and legal teams have their way of drafting. At least a core part of it in terms of explaining the business, in terms of explaining the rationale for the transaction and the accounting. So these aspects, at least I go through in every merger or demerger, understand whether we are all on the same page. If not, have a conversation with the auditors of the company and others to explain to them why I see this valuation a certain way and why I'm doing certain things. Then come to a consensus. So if they have certain reservations, because ultimately the auditors of the company know more because they've been engaging with the company for a much longer period than us, right, as valuers. So if they have certain reservations, some other point is brought out, then we consider that and think of changing the method of valuation. Or we convince them that yes, you go by this, and we tell them the accounting treatment in terms of what needs to be done. Whether we are going, simply put, under AS 14, are we going for purchase method or pooling of interest method? Under 103, are we going for acquisition method or pooling of interest method? Right. So this feedback should be given to them, and more importantly, the purpose of valuation should be the same. I cannot say, I cannot say the company has common control and it's being done because a group wants to consolidate. When for example, the scheme cannot say that by merging and there's going to be further investments, etc., etc. There cannot be a mismatch in the scope of the work itself, because ultimately what is written in the scheme and my report should match. The report is part and parcel of the scheme. Now, obviously, the auditor is the one who will give the certificate for the accounting aspects, etc. But we tell them, because a lot of times, because they might not have worked in valuations, or they might not be familiar with what happens in valuations. So we brief them on what can be done or what is the treatment done, and they are usually fine with it. Uh, there are also a couple of cases where I've told them post the merger how to account for the transaction, etc. Just guided them on those fronts, which is there. So those are also things which usually people come back to us asking how to do it. Especially if the transaction is a bit complex, they might ask us on how to account for it, what for certain suggestions and opinions in terms of what to be done. So this is the background. So first, let me start by covering a few. I think we all know this, but I just wanted to cover certain basic aspects just as a refresher. Because we are all extremely familiar and we keep doing it, sometimes we forget. So I thought we'll have a very quick refresher on some aspects of these things. So the legal backing, obviously, for any transaction under merger or demerger is through the Companies Act. Broadly, two processes. I'll be looking at 230, 232, but broadly speaking, there are two processes. One is through the NCLT, one is the fast track merger through the regional director. So these are the two processes available. Obviously, the fast track merger is for the small companies, whereas for all the other companies, it is through the NCLT process. So in terms of accounting, as I just pointed out, there is Ind AS. Ind AS has certain aspects or certain way of looking at it. Again, our regular accounting standards issued by ICAI has certain conditions and way of looking at it. We'll also look at the taxation side, because ultimately, as I said, any transaction, any merger or demerger, or these sort of transactions, slump sale, any rearrangement transactions, so much, right? Ultimately, if you think about it, all that is happening is that there is a group of people who are interested in owning certain assets and liabilities, which are a business, right? And these assets and liabilities, which end up being a business, are just being rearranged now in this scheme. So from taking from one pocket to putting it into another pocket, or taking it from one company to another, just moving the assets, and who is controlling what. That's what has been changing. And the ultimate aim is to do this in a tax efficient manner. Right. So simply put, it might seem reductionist, but to say that tax impact is always one of the most important key considerations in terms of what a person is. Why we spend so much on doing a merger or a demerger. It's not a simple process or a cheap process, even in terms of cost and time. It's a very sometimes it takes us a couple of years to get the approval. There's a lot of other considerations involved. We jump through all these hoops simply because if we were to do the transaction any other way, right? For example, doing a slump sale or a simple sale or whatever else, would lead to a huge tax outflow. So the one of the primary reasons for people to undertake this is to look at saving on tax, and it's recognized by the tax authorities, right? That is one of the primary key motives of any merger or demerger transactions. Other
What should be the
permissions are required
minimum
by
tax?
yes.
If at least this is the benefit which anyone is getting, then because the cost is there, time, efforts, energy, and there is a lot of hidden cost, as you are aware. Creditors meeting, shareholders meeting, the NCLT will appoint certain scrutinizers and all of that. So considering this, you would like to share with us what could be the break even point below which no professional, it's not economical for the company.
I think that also depends on the case we are handling and the indirect costs involved, the hidden costs involved, so to speak. I mean, RD mergers tend to be cheaper. So if you're under the small company merger or demerger, so if you're under the RT, then I think we are going for a RD scheme, then it's not as costly as say going to NCLT, which is, as you rightly pointed out, is a more time consuming process. We generally look at, I think it needs to be worked out, but usually I think one basic thing to look at is whether the company is having properties on land and building, right? The second there are land and buildings, there are other, there is a stamp duty involved and there is a sale and there are registrations to be done. So the capital gains tends to be very high, especially in India. Traditionally, a lot of companies within, have lab properties bought very, like at least 20, 30, 40, 50 years ago. So in these cases, any capital gain sale will lead to a huge outflow of tax. That is one. Second reason, what we look at in the balance sheet is investments held. So it could be shares in other companies, other group companies which are doing really well. So there could be holding companies and various these sort of things which are there. So even in these cases, there will be a lot of tax outflow ultimately. So even in these cases, we look at what needs to be done or how to do it, right? Uh, yeah, so I will cover those aspects in detail when we are looking at the section and what are the benefits which are there. We'll just run through the sections as I said as a reminder. The process is very simple, but how do we fit it in and what are the circumstances we fit in is basically based on the what the company's access, what the accounting standards say, and what the taxation impact is. Right. So ultimately, based on this, we take a call whether we go for a common control or in terms of maximizing. And obviously, most importantly, valuation standards, how the valuation standards allow us to do this. Because if valuation standards do not provide for something and do not allow us to do something, there is no way we can, as valuers, we can do this. We can do it, even if it makes the most practical sense, even if it sounds the right thing to do. If the valuation standards do not have a provision for doing it, we cannot do it. Just to give you an example, recently I had to do a value allocation exercise for a company. Uh, it is very interesting that so under the latest valuation standards amendment, allocation of value para has been clearly brought in, where under certain circumstances as valuers, we might our exercise might actually have to be a value allocation exercise and not a valuation exercise per se, right? So there is a clear part brought in, and because valuation standards allow that, I was able to do that value allocation exercise, right? So it is important for us always to keep reviewing the standards, reviewing the tax changes. Valuation standards are also revised once in 2 years, 3 years. So international valuation standards, I mean, ICA valuation standards tend not to be reviewed as often, but international valuation standards is what are reviewed time and again. So based on that, there are a lot of things which we can do or not do, right? Yeah, and other impact change in land records. As I just mentioned, a stamp duty would be involved for properties. Different states have different rules. Some tend to be costlier. For example, Kerala tends to be extremely costly in terms of stamp duty. At least from my experience, because I have handled only these cases in Tamil Nadu and Kerala mostly, and some in Karnataka, involving in Karnataka and Andhra, Telangana, but nothing outside of the south region in terms of land records, because mergers tend to be usually done in that particular region itself. Uh, what I have seen is of the south states, Kerala tends to be the most expensive in terms of stamp duty and other terms of the consideration involved for the government, whatever is to be paid to the government as fees. One more important aspect which a lot of people forget to look at, and as I said, devil is in the detail, and this is a detail which both a lot of valuers and others involved in the transaction forget to look at, is assignment of patents and trademarks, right? So, and this is a very interesting situation where recently I came across for a client of mine. They had done a transaction a few years back, based on which they had done an acquisition was done. I'm not getting into the modalities of how it was done, etc., and who are the people in it involved in it. Just as a background, so what happened is they have acquired another company, and at the consolidation level there's a merger which has taken place. So this is an acquisition by purchase of shares and not by through a court driven process. But what is interesting is, in any merger or acquisition done at a price, right, there is a need for something called purchase price allocation under Ind AS, which has to be done. Now when this purchase price allocation under Ind AS which has to be done was done, they had not recognized the intangibles which were there. Now, when I say intangibles, it is not just patents and trademarks what I've given here. There are also for the purpose of 103 and meeting the conditions of the intangible standard, there are a lot of other hidden intangibles which will be there, which now have to be recognized, right? So the company had not done that. They had actually originally they had come to me and I had given them a certain quote based on the work to be done, saying that knowing the background, knowing the thing, I had given them a quote, but someone else had quoted, and I mean, obviously they tried negotiating, and the quote was very low, and I said, sorry, I can't match it because there's a lot of work involved. Uh, Now, fast forward few years later, where that same company had to undergo a different transaction. Now, when the balance sheet came to me, I did the valuation as per whatever for whatever regular purpose, etc. And it was not the result the management was expecting, right? And the main reason for that was the goodwill sitting in the balance sheet, right? What is that goodwill? Goodwill is nothing but the residual amount after allocation to independent assets. Now, the funny thing in India is that goodwill can only be impaired. It cannot be amortized or depreciated, right? Which means an entire impairment of assets should have been triggered over the years, which was not done. Now, I cannot, when I'm doing a valuation in the middle of the year, I cannot trigger an impairment test. And a large company where there's a big sizable amount of goodwill sitting in the balance sheet cannot randomly trigger a impairment test in the middle of the year. Correct? It should have been done over the years uh, by the auditors, also should have commented. So it's a problem for everyone. If something is not done properly, it's a problem for everyone, especially when it comes to intangibles and allocation and things like that. Impairment will have a huge impact. I mean, we cannot overnight suddenly say I'm writing off 200 crores, 300 crores of value from a balance sheet and just say it's going to be done. Typically, what happens is once you account for a merger, right, in your console at the console level or at a standalone level, the next period itself, an impairment test has to be done under the impairment standard. And the reason for this is because there is a difference between the definition of fair value, as I'm digressing a little, but this will all explain why common control is also important. Since we touched upon this, I just wanted to highlight a couple of points which have come across. Uh, See, the value impairment standard says it's fair value less cost to sell or value in use, whichever is higher. Whereas our the 113 fair value index is fair value is the price, right, or the estimate of price which would be used. Now there is a mismatch between both the statements, so there is inevitably, invariably a trigger for us to do an impairment testing, right? So while accounting for it, you might account for the transaction at a higher value. Subsequently, in the next period itself, you can technically do an impairment test and write off the value if it's not making sense. And it makes a lot of common sense. See, if your ultimate aim is not to carry the goodwill and you're planning to do a lot more transactions in the future, and the goodwill could have an impact, because ultimately it is an value of net worth. Goodwill is nothing but a value of net worth, which actually is not backed by any asset, right? It is only a notional amount for which I have paid. I've paid an extra price. It is an asset which, for a valuation purpose, is useless, right? I cannot bring it in. I cannot use it for anything. I cannot really move it anywhere, right? When I'm doing an impairment test. So ideally, it is better to do an impairment test in the next period or next couple of periods and write down the try and impair the goodwill. Obviously, the amount should be over and above the value done. So, large story short, whenever you're dealing with intangibles and there's a purchase price allocation in a merger, do it properly. Advise the clients to do it properly because it will come back to bite them at some point, right? Very important because goodwill cannot be amortized or depreciated. It can be only impaired, and impairment testing is a larger event, especially if your balance sheet is 1,000, 2,000 crores. It's not a overnight event where you can randomly just impair one asset. You'll have to test for the entire, we have to identify the CGUs, allocate the goodwill to the respective assets, and then test it and then write it off. So it's a big exercise. So it's easier to do it over a period of time. The assets also tend to mingle, the involved in the transaction tend to mingle. The workforce related intangibles might have disappeared completely. There are other intangibles which might not have identity at all after a couple of years of merger. So it's better not to, even the assets could have been moved, could have been changed to a different CGU. All these things could have happened, and it's extremely difficult to go back and test. So try and do the test as early as possible and allocate as less of, and while doing the PPA, allocate as less a value to goodwill as possible. So do the fair valuation. Now, large story short, why did I go down this rabbit hole? Is because patents and trademarks and other intangibles tend not to be valued properly when we are doing a merger and any of these transactions. Now, there is a stamp duty to be paid on the patent value, right? Patent or trademark, when the assignment is changed, there's a stamp duty to be paid. And this is also a significant amount. It is not a small amount which has to be paid, right? And usually what I also see in a lot of cases is people put it as a transfer from one company to another and not really as a like more shown like more like a sale transaction than a transfer transaction, because apparently what the patent lawyers tell me is that to show it as a vanilla transfer transaction, it takes a long time to get it cleared by the patent office. So they usually just put a notional value, pay some stamp duty on it, and they transfer it. They don't wait for the to have an assessment done for a transfer, etc. Like what happens with the land record. At least with the land record, there's a published guideline value which we can use. Whereas here that is not available. So people tend to just put some random value and do a transfer assignment. But from a valuation perspective, it's important, both for the purchase price allocation and when we are considering these things in the balance sheet, right? Ultimately for a valuation, what has been recognized. So when dealing with any merger, this is something which has to be done. Common control mergers are different, because what happens is under common control mergers, because we are going under book value, these patents and trademarks would not at all have been recognized. So let's say if it was a very small cost, say the legal fee or something was recognized in the balance sheet, the same value is going to be brought out over here. So in common control transactions, this is not such a big worry for us. We would just carry it in the same book value. But if we are doing any other transaction, we need to be very careful about the value assigned to these things. One more area which I see as far as patents and trademarks, and actually even other intangibles where there are other government regulatory authorities available, is that somewhere along the way they are going to wake up that these mergers are happening and there's a stamp duty involved or a tax involved on these transactions, and we are actually not declaring the correct value. Right. Let's say we are working, I think most of you are from Bangalore. So let's say you're working with a software company. There's a merger which is happening, let us say, for a few $1 million. There are no assets in the balance sheet. There's no property in the balance sheet. There are probably some computers and chairs and tables in the balance sheet. Uh, whatever few $1 million is being brought in is not being brought in for the chairs and tables. It is being brought in for the intangibles which are there in the company, right? Which are various internal processes built, which are various capabilities built, workforce built, etc. Right? So you cannot just say that there is no value to all of these things. There might be some trademarks there, there might be some patents which the company has generated, processes which the company has generated. You cannot say the value is zero. There is a certain value to it. The only thing which has happened, we tend to just have as minimum a cost as possible because of various reasons. But going ahead at some point in time, we are at what 5 years since this valuation standards have started, but with maybe somewhere within the next 5 years, these other authorities will also wake up and start questioning why I shouldn't be taxing these transactions or receiving a higher sum of money, right? So be careful, watch out for those things in doing, and which is where a common control. So the larger point of all of this is, which is where a common control transaction also makes sense, because the valuation standards allow me, various other things allow me, being a court-driven process, to do this as a value neutral or a taxation neutral transaction. The intention of doing a merger is ultimately to be a taxation neutral transaction, right? Or to not pay unnecessary duties and taxes, because all I'm doing is taking from one pocket and putting into another. There is no question of fair valuation principle over here. So let's just quickly
Vishesh,
run through.
one second. The stamp duty
Yeah,
point, what you have raised, okay, is to ensure that what PPA allocation, that accounting treatment the company is doing, vis-a-vis the stamp duty, the consideration, whatever is mentioned should
yeah,
match. That is the point which you are
correct.
highlighting, right?
Exactly. That is what I'm trying to highlight. And so I think, sorry, I didn't finish that part properly. So yes, it should match, both the values should match. Rather, if you are now showing a higher value in the balance sheet, let's say you showed 1 lakh for the purpose of transferring the patent or trademark. Now you are saying it is worth 100 crores, right? Obviously, at some point, right now they might not know it, but some point down the line, there will be a clear question being asked, right? That how you have said 1 lakh here and paid whatever 7-8% as a stamp duty on it. Now you have accounted for it at 100 crores. Where is my money? right? So this is the be very careful in terms of what we are declaring and how we are going to do it. This is an area of litigation which I see arising, and this will especially happen in Bangalore, being an IT hub with a lot of intangibles, right? It takes time for the authorities to catch up, but at some point it will start. uh, Invariably it will happen. Even in Chennai, I'm expecting this to happen. So what happens in these cases is where there are a lot of companies with intangibles, the people will start waking up, even though in that particular offices, that particular area, valuation is not well understood by a lot of people, right? Or the purpose of these mergers, etc. It's not understood by a lot of authorities today. So we don't really get we don't people don't really get what is it which has happened. In fact, I don't think even any of the other enforcement agencies, everyone out there even understands who a valuer is or what is their role in a transaction, right? So as we go ahead, we will see questions being asked of us as well in terms of how you have valued, how have you allocated value, etc. Be very careful, tell the client of these impacts, and talk to their legal team. If you're what is the value you're showing for stamp duty, what is the value you're going to show for stamp duty. Ultimately it doesn't bother us, but you should explain, right? We are going to do what is right. If the value is 100 crores, we will show 100 crores. If they are showing 1 lakh, it is their problem. But as a general thing to point out to a client, we need to tell them, highlight these issues to see what is the impact and what is the risk, right? So I cannot be accounting, say, at 100 crores and they've paid tax on 1 lakh. It's absurd. At some point, if the assessment comes, they cannot come and say, so you told us to pass this entry, I passed, now I have to pay tax, right? So that is how our clients will come and talk to us. They are not going to say, oh, you have done a brilliant thing in purchase price allocation. You have saved me from giving goodwill. Now I can amortize this value over, over a few years. Especially, let's say I'm holding a trademark or patent or something. And what also happens is these things tend to have indefinite life. Patents don't, but trademarks, especially for a good brand name or anything like that, they tend to have a indefinite life, and indefinite life will also be not amortized, right? So the amortization test or the impairment test will happen only year on year, or when there is a significant change in business, which might not happen anytime soon, right? So under those circumstances, it gets very difficult to, once you put a value to it, it's very difficult for the company to do anything else, and it will be carried in the balance sheet. And any subsequent M&A transaction would have to be done using that value. It cannot be written down. So there are a lot of impact in the accounting aspect of value of the M&A transaction also, which is why to me personally, it is always important whenever I quote for a valuation exercise for a M&A. People always ask me, why are you charging something higher than what others are quoting? Or I got 3, 4 quotes, your quote seems higher, etc. The main reason is our involvement needs to be more than just a valuation exercise. We need to work with the secretarial team, understand the scheme document, know what are the nitty-gritties of it, talk to the finance team, understand the accounting aspects of it, right? And then look at the valuation aspect. Now, we cannot say, I will only do the value, you all do what you want to do, I will do only the valuation. The ultimate purpose of us being engaged in coming into a transaction is for the transaction to go through, right? The client can always look at us as another checkbox, but we can look at ourselves as a checkbox, and we need to advise the client on the full range of whatever are the issues to be handled in an M&A transaction, right? And it usually the questions come back. There are times when people ask me what to fill in this form. I don't even know any of the secretarial aspects, but I get sent a secretarial form and ask, so what should I put here, right? So over a period of time, you just pick up and you learn from whatever questions are being asked. But our role is much larger because people don't understand valuations. It's all a new area, and we are seen as a professionals who know everything. We are expected to answer a lot of questions and pick out and highlight these things, right? So there was a case where it took them 2, 3 months to get back because there was an amendment in the Kerala stamp duty. So we had to go and get a legal opinion, etc. The client, I told the client, you get a legal opinion because I have no clue how Kerala works or the stamp duty, etc. And I'm not a legal expert on stamp duty. So you get a legal opinion. So the transaction was put on hold for 2 months till they got a clarification on the stamp duty, because we were proposing something. I had proposed a transaction, structured it, etc. We had given that, but suddenly the client highlighted somebody highlighted that this is there's so much of stamp duty outflow which will be there. What do we do? So I'm not going to be interpreting it. It is left to the lawyers over there. And obviously, if we have to talk to the legal team and explain how I'm planning to structure it, what is the impact, etc., it's left to them to interpret, like give the details and then interpret. So again, that is not something which, if I'm quoting for a, if I send a day one quote with something as a minimum value, there is no room for us to. There's a lot of professional time which is being spent on all these aspects which are there, for which we also have to remember, that we have to charge at some point. So typically, what happens is in most of the M&A cases, what I have seen, whatever I quote, I go over and beyond the scope in terms of having to answer questions to different parties involved. And there are multiple meetings, physical, online, whatever may be the case, with various people to talk about the transaction and how to do it. Right? Okay, so I've digressed quite a bit in terms of talking about M&A in general and the issues faced, but all of it is relevant to common control in terms of how common control simplifies all these processes and why it's an easy mechanism for us to do a valuation and finish the transaction. So quickly, let's just look at the sections which are there. As I said, it's a compromise or arrangement is the terminology used under Companies Act. There's no question of a merger or a demerger or anything specific under Companies Act. The idea here is simple. There are so many things you can do, right? It is you can issue CCPs, you can issue CCDs, you can do buybacks under this. There are so many transactions which I can do and which one can take up and do. And there's a very powerful section, right? 230 to 232 of Companies Act is a very powerful section. And of late, if we are also here looking at cases where under IBC, even under liquidation, liquidator has, if you very clearly see, liquidator can also come under 230, 232 to go for a compromise and do a settlement and do a merger under this, right? So all these options are available to us, right? It's not that they are not. There are so many things which can be done, and it will allow us to, uh, you know, uh, carry out various types of transactions. So I think there are CCPs which are issued by various, non-convertible preference shares which we have seen issued. We have seen convertible debentures issued. We have seen warrants. We have seen various schemes which are there, and so even if you have a private agreement, let's say you want to bid with say a creditor and you want to compromise with them, and you're entering into an agreement to say convert some of their loans or our, let's say the creditor balance is given to a shares or through a preference shares, etc., you can go under 230 and you can do it, right? It's entirely possible. I'm not going to dwell deeper because our focus here is the common control transactions. um, yeah, so here you can clearly see involving merger or demerger of any or two more companies, or it can be for an undertaking, or it can be for division of companies or rearrangement. All of these things are fully covered under these 230 to 232. Now, one thing which I want to highlight over here is that, see, if you see clause J, I'm not getting into the other aspects, but if you see clause J, very clearly the accounting aspect also has to be part of the scheme, which is what I was talking about. And if any scheme you're giving, anything you're giving, if you're not able to satisfy the accounting aspect of it, the merger will not be approved, right? It is important, and usually this will be pulled up by the RD or ROC when they are looking at the scheme, because their comments are also invited on the scheme. If you are not clear on the accounting aspect, they will not, they will raise queries on this, and we'll have to clarify, right? When we are doing research for mergers, and especially when we are doing something unique, we come across a lot of cases where the schemes are filed, the schemes are looked absolutely fine, but these aspects were not done, and these were done by top legal firms, right? So even when a top legal firm is engaged to do these transactions, they might, the problem there is that they are legal experts, they are not accounting experts. Now, when they are not accounting experts, they might not be able to comment on the accounting aspect, they might not have it reviewed by a proper accounting expert, right? So again, as a valuer, where is the check where we can, obviously as valuers, we also need to be clear is this: when we are giving a valuation report, we need to look at what is the accounting treatment given and whether that will align with the valuation we are doing. If the accounting treatment does not align with the valuation we are proposing to do, then that has to be changed in the scheme document. Or we have to look at why there is a difference in both, whether which takes higher priority for the client, and then we have to look at what needs to be done, right? Uh, so then comes the small companies and 100% holding subsidiary where no valuation report is required, which goes to the RT. Think one change difference is for small companies, valuation report is required. We do need to submit because obviously the swap ratio has to be given, right? Only thing is, or even for demergers where we have to certify, But for 100% holding subsidiary, no valuation report is needed because ultimately there is no change. One of the clear things, as I said earlier, we are only arranging and rearranging assets between various pockets. So ultimately, only when there is a change in the underlying owners of the asset, that is when there is an impact on equity, is a valuation report required under Companies Act as such, right? Uh, Whenever you're doing, even if you see for non-convertible preference, non-convertible debentures, we don't issue valuation reports because there is no impact on equity. Ultimately, whenever there is an impact on equity, the general rule of thumb, so to speak, is that whenever there is an impact on equity, we'll have to do a valuation. Moving on, yeah. So coming to the large story. So obviously, this allows, though, because of the breadth, length and breadth of what 230 and 232 covers, common control transactions are allowed. There is nothing restricting us from doing these sort of transactions. It is entirely about approvals. It's about process. And I think, as all of you would have studied, the legal precedence is very clear. When commercial wisdom is used, these transactions can go through. And in these sort of transactions, the owners of the company or the creditors or whoever else is involved in the transaction applies their mind and then approves the transaction. These are not simple transactions where it has to be at arm's length or something else, because obviously there is a special interest involved by already being owners or having an interest in these assets. And I would like to undertake this is always treated as a special or a unique transaction by the courts over the years. Yeah. So having said that, so now 230 to 232 allows us to do common control transactions. So what is this control I'm talking about? Ma'am, can we just take a 2-minute break? I just want to take a small break.
Yes, yes, definitely. Meanwhile, I request the participants to share their experiences with respect to, mergers. So many points, Mr. Vishesh had highlighted. I request the participants to unmute themselves and share their experiences with respect to merger, demerger, or any such practical issues.
Madam, I didn't know that the small industries or small companies are also not required to do a valuation in case of merger demerger. Is it right?
I think the continuation was 100% holding subsidiary. Even I was confused when the speaker said that.
He said that small companies and 100%, 100% I agree, but small companies also not required. Then majority will go.
It is, according to my understanding, it is required. Only condition is and, I think it's under 100%.
It is my understanding also, if it is only a holding subsidiary where there is no impact on the equity, there is no valuation required. Otherwise, definitely there is a valuation report required. Maybe we can ask him to clarify this aspect.
Yes.
If it is a holding subsidiary, even if it is not a small undertaking also, it is not required anyway.
Even my understanding is that.
Agree on that, sir.
Mr. Ravi Shankar, you would also like to highlight us any of your experiences with respect to merger reports, valuation reports?
I did very few in that sense, but not a complicated thing like this. Okay, basically just a plain valuation. I'm not a expert on this. Okay, right.
Correct. My takeaways, yeah, please go ahead. Sorry.
No, I had done some small valuations where ratio, exchange ratio, and this kind of things. That's what I had done, but not more than that. But they were plain, simple companies.
My takeaway from this session is normally maybe I come from a company secretary background. I have never seen that there is some accounting treatment which I had to focus on to align with my, maybe by default it was getting aligned or someone else was taking care of this. We were checking all other aspects in the scheme. Maybe I have never focused on accounting treatment.
So it is my understanding that after the valuation is done, when the acquiring company is actually acquiring those assets, there is another report that is actually required, which is which will act as the basis for those accounting transactions. Maybe the speaker can clarify on this as well.
Yeah,
for every merger, NCLT will ask for this Altus opinion saying that accounting standards are complied with. That's the mandate.
Correct. So that complied with is basically reassurance, but it has to be in the scheme. So it's basically the undertaking from the auditor is only basically confirming that, right? It's basically even the valuation and the swap ratio. So the swap ratio is also given in the scheme, right? The values of the companies and the swap ratio is also in the scheme. So the scheme is the ultimate document which is approved by the court. So the auditor certificate, valuation report, etc., are all the supporting documents based on which it is done. The scheme is approved. The order will only contain references to the scheme. It will not contain references to our valuation report or through the auditor certificate. So it has to come. Ultimately, the scheme is also the petition for which we are getting the approval from the court. So the scheme should have the details of the accounting aspect also. It is necessary because, see, tomorrow if there is any other issue comes, right, and any question asked by any authority, the second it is there in an order, court order, they cannot challenge it, right? They should have they had time to they should have challenged it at the time of the merger itself. So that is why we try and it has to be very clearly mentioned in the scheme document what is the accounting treatment. That is why we actually focus on that. And especially when I'm doing complex transactions, I at least bring in the mention that this is how, so it is in compliance with say 103 or in compliance with 14, or if there is some other aspect to be done based on whichever other standard gives a particular guidance on that particular aspect. We mentioned that there are times when we also get asked the question before a clearance on what we are going to do. The problem is if we don't figure out how the accounting is to be done before the scheme is submitted, if something is approved, tomorrow we are not able to execute, it will become a problem. We can't go back to the court and say there's an accounting issue, so you have to change the scheme. They will not allow us to do that. So better to bring it into the scheme, cross-check how the balance sheets will look after the merger, and then get include the accounting aspects and get it certified. That certificate from the auditor is needed. We'll have to be giving, but invariably, see, the CA will be an expert in accounting in the sense that majority of the companies, especially when we're dealing with smaller companies, the chartered accountants might not have been dealing with mergers and acquisitions day in, day out. So for them, it's a unique transaction. Since we are handling this regularly, it makes sense for us to explain to them what needs to be done if they want meet them also if it is needed, and then they can take their concurrence, have a concurrence on that. That's what I was trying to highlight.
There is no separate PPA report which is taken.
PPA report is not taken. There is no PPA report. PPA is an accounting for the company to be done under the accounting standards, right? So I think
This is what we are
so
referring
that
to,
we have
right?
do.
Actually,
No, we are not referring to that. What also happens is which method of accounting. So are we going under acquisition method? I'll be covering this. So whether we are going to be going under the acquisition method or whether we are going to be going under the pooling of interest method. So first step is that, and within that, what are the value? What sort of value should be taken? Is there any adjustments to be done, etc. So it's better to put all of that in the scheme itself and have an approval. So tomorrow, even if any question comes from income tax or some other authorities, we have a clear document explaining how things were done. And second, it's court approved. They cannot go back and question and say, we don't agree with this. That is the idea. Okay. I think let me just move on to the common control part. So control as per Companies Act shall include, so one, it's an inclusive definition.
Mr. Visheh,
The right to appoint.
Mr. Vishesh,
Yes.
one doubt what we had when you were on outside. Small companies don't require this valuation because you
They
said
require.
there were small companies and holding companies. You said.
No, there's a comma missing there. 233 is for both. Small companies valuation is required. Yeah, it is basically anything which will lead to a change in equity, valuation is required. So even under small companies merger, valuation is required because we have to give a swap ratio. Okay, moving on. So control shall include the right to, now most important aspect here, this is an inclusive definition. There are other circumstances where there could be control, where we can demonstrate control, but usually understood is that the right to appoint majority of directors or to control the management of policy decisions exercisable by person or persons acting individually or in cohort or in concert, directly or indirectly, including by virtue of their shareholding or management rights, or shareholders' agreements or voting agreements, or in any other manner. Right? So the entire basis for my common control valuation lies in this definition, what I'm talking about. And last time, I think some of you might have attended, I would have shown you one very complex diagram, and I said we merged all of these things. Uh, it was done using this entirely using this definition of control, and then obviously then the accounting standards interpretation of control, and why we can go and the valuation standards interpretation of what we can do when there is control, right? So this is the base building block for all common control transactions. Ultimately, we are giving a valuation under Companies Act, and that is the starting point. And we need to satisfy control as per this definition, and we need to demonstrate this. Right? It's just thought that yes, this guy is holding 90%, and it is understood that they are control. We need to demonstrate this. Sometimes when the owners are the same, let's say there's a one holding company holding two subsidiaries, it's very easy. All you have to do is get a certificate, a resolution or a management representation from the holding company stating that I exercise control over these two and intend to exercise control post merger on these two, these two assets when they are merged together again. It's as simple as that. But suppose I'm dealing with a group of individuals who are, so what happens here? You can see it's acting individually or in concert, directly or indirectly. Right? So in those cases, what happens? I need to have the group of people saying that we are acting together. Now, how do I get that? We need that consensus, right? So in a lot of family concerns, for example, the case which I had discussed the last time when I was at BVA, where we had 13 companies, where there were some of the companies were directly controlled by them, some of the companies were indirectly controlled, where through other companies they had invested in these companies. But in those companies, again, these 6 people were the only shareholders, right? So ultimately, what we do is we did a documentation where all these sort of cases, we tell the family members to draft a overall document stating that for these companies, I own all these shares. And yeah, and there are a couple of questions in the chat box. I'll come to it once I finish this part. So I take the overall, we draw a document where we talk about what are the companies, etc. And we pass a sort of a resolution, and we have all the people sign, right? And as a part of the documentation to say that we are all family members, and we own XYZ percentage in all these companies, and we subsequent and to the merger, we intend to continue in controlling these companies and using and using these assets as we all deem fit together, that there will be no split in the assets. Right? Only in these circumstances, I need to demonstrate. So having such a document clearly demonstrates that we intend to act together and that there will be no claims from any of the other parties. Now, common control necessarily means that majority of the shareholders or all the people involved are going to be the same. So later on, whenever there is going to be any issue, these will be the same people who will come and raise and probably go to NCLT under operation and mismanagement or something else. So we need to clearly demonstrate that there is no such issue underlying, or we are not aware, because we are usually what happens in any transaction is we are dealing with the auditors, we are dealing with their probably the CFO or somebody. In a valuation exercise, not everything is disclosed to us which is happening in the background. So this sort of document will help us, one, demonstrate clearly that there is control and there is common control and it will continue to be there. Two, tomorrow no other claims can come against us for going under a common control transaction. Okay. Uh, Sometimes it's okay. Brief. No. I'll just come back to the questions in the chat box. So, in these sort of circumstances, remember always to have it clearly demonstrated that the common control exists and people all come together and sign. Now, if it's a company, then you need to have a board resolution done, clearly stating that this is a common control transaction, and it will this is how it will be. That we'll continue to control this company going forward. Now, it can be one important aspect here is this covers both uh, control through shareholding and control through right of point directors, that is the management. Having said this, important aspect here is lot of cases, I'm talking about cases where 100% is owned or 90, virtually 95% or more is owned, the issues are less. But even in those cases, you will have to be very, very careful about the presence of minority shareholders and the value impacting them. Right? What I mean is that if there is a minority shareholder and they are going to lose value because of this common control merger. Invariably, when we are going by book value, there shouldn't be a loss of value. There can be a gain of value to these minority shareholders, but there should not be any loss. If there is a loss in value, then we cannot go under the common control transaction because the interest of the minority is being lost. Now, the accounting standards think otherwise. The accounting standards say you can use pooling of interest irrespective of whether the minority is affected or not, which is fine. But where there is a catch is that if you look at the guidelines issued by MCA, the rules which have been prescribed by MCA, we have to consider as valuers, we have to look at the public interest or the larger interest which is there. Whereas accounting standards are framed from an economic point of view. So, which is why I said there is a difference between the accounting standards have evolved from the academic side of valuation and research, which is that the base over there under neoclassical economics is that the economic value of something matters more than any other aspect. But under Companies Act, being a legislation, what matters is a public interest or other interest also has an impact on how a transaction is being conducted and not just an economic value. So because there is a disparity in both, whenever we are doing a transaction, even when we are able to demonstrate common control, we also need to demonstrate, if not to the outsiders, at least to ourselves, right? And hopefully to everyone who's going to be there in the transaction, that there is no value lost to the minority because of this particular transaction, right? So invariably, if we can be neutral, but we can ensure there might be a slight gain to the minority because of quirks of the transaction and common control. It can happen sometimes, but there can be no loss to the minority. If there is a loss and it is significant, then we could be in trouble. The other way to look at it is if the minority is also someone known to the people exercising common control, let us say they are a distant relative or they are a friend or something like that, then you get them also to sign off that I understand this is the scheme, this is the proposed scheme, and in this is how the control and shareholding will change, and I'm fine with that. Right? You have them also sign a document, you explain to them, you create a document, and you get it signed by them. Because tomorrow, there cannot be any question. I mean, as a valuer, there is no problem because we will always say we talk to the company gave us the documents, this is all I can demonstrate. But on the other hand, the transaction doesn't go through. Ultimately, if the transaction doesn't go through, then we can't really do much. Right? It's very heartbreaking sometimes to look at the effort which goes into a transaction and it doesn't happen. There are two transactions of, which where we have worked really hard. It didn't go through not because of reasons to do with valuation, but to do with reasons of very silly reasons. Right? In one case, a transaction didn't go through because somebody in the company secretary office copy pasted the swap ratio wrongly. Right? Everything was approved, but they noticed a mistake in the scheme, and the court said nothing doing. You come back from the first. I don't know. I don't know what happened in court because I didn't attend the hearing or see that. But this was what was told to me by people that there was some mistake in the scheme document and the court said come from the beginning. So nothing to do with the valuation. Everything was perfect. But even despite all these cross checks and everything which I do, somewhere along the way in the final document submitted, some mistake has happened and the transaction was cancelled. In another transaction recently, we got the transaction cleared by the exchanges. We got the transaction cleared by the merchant banker. We did a lot of things. Everything was done. But the company had not realized that post the merger, their shareholding in the company went above in the merged entity. Because of the merger, the in the merged entity, the promoter shareholding went above 75%, and you can't have that by SEBI. Even if it is 0.001% or something like that, SEBI does not allow it. And this work was not noticed by anybody because there were a lot of changes being made to the ratios, etc., etc. We were working on it, and somewhere along the line, nobody thought about this particular aspect of it. Once we filed, we realized, once SEBI raised this point, we realized that this is not going to go through. We obviously said that let the merger happen a portion of the shares will be liquidated in the market, etc. But SEBI did not allow that, saying that there are a lot of such companies waiting. We cannot allow you to do it, right? So even despite so much of effort which goes into a transaction, there are cases where transactions don't go through for various reasons. And that's why I insist on the documentation. And in these sort of common control transactions, documentation becomes even more important to demonstrate to yourself, and you're not dragged into an operation and mismanagement case that asking how you valued what you did, etc. Have the documentation done. Have all the people involved sign the documents. It obviously changes from transaction to transaction. In some cases, as I said, if it's only there's a holding company, there are two subsidiaries. We are merging the subsidiaries together. Not much to worry about or think. You just get the holding company to pass the resolutions and do the test to see that there is no loss to the minority. And then you can go ahead with the transaction. There's not much of an issue. But there are complex cases, especially when we are dealing with larger family concerns, huge groups. We don't know the story, right? Who's fighting with whom? It's more like a mega serial rather than valuation exercise at that point, where you cannot get into who's who in the family and why they have fought, and they will tell you stories from 50s, 60s, great grandfathers. We cannot have all of those things. We need documentation. So you try and get the family to come together, pass sort of pass a common resolution, and use that as a part of your documentation, right? Have that. If possible, reference that in your valuation report also. This information para which we declare in the valuation report is very, very important, right? Clearly mention what are the documents you have received and used. Beyond that, no authority can claim you have based your judgment on that. If that documentation was sufficient for you to take the judgment on valuation, you are good, you are protected, right? We are not auditors ultimately. Our liability is restricted to what we are doing in terms of valuation. But at the same time, there is always a tendency for every authority to drag you into a case, because more professionals, the merrier, because more outsiders will put pressure on the parties to settle or do something. So don't get dragged into it. That's about it. Okay, so as I explained,
So
this is
as a
the
valuer, I ensure on this documentation, mention in the information para and give a simple book value swap ratio.
that's it. So I look at why we can do that. Like book value swap ratio, as I said in the beginning, that's all we do. But documentation is key. So we have to demonstrate the control, ensure minority interest is not affected, and then do the book value based valuation and go by that. So what allows us to do this? Now, under Ind AS, there's something called the acquisition method. Uh, it's pretty much, it looks similar to the purchase method. There are slight nitty-gritties and differences, but simply put, this is the acquisition method. You identify the acquirer, you determine the acquisition date, you recognize and measure the identifiable assets acquired, liabilities assumed, and any non-controlling assets in the non-controlling interest in the acquiree, and you recognize the goodwill or a bargain purchase. One. Two, this is for all regular transactions. I'm not getting into the details. What we are interested in. So under Ind AS, you cannot go under any other method other than the acquisition method, right? It is compulsory in the books of the acquirer. This is not for the acquiree. This is in the books of the acquirer. 100% you will have to go through the acquisition method. You are not allowed to go through any other method. But the exception given in the appendix of Ind AS 103 is that business combinations involving entities or business under common control shall be accounted using the pooling of interest method. Please see this. The word used here is shall, right? It is not can be, it is shall be. Because recently we had a case where we were wondering whether, for whatever reason, whether we can do this under some other method, right? For whatever purpose, whether we can do that. But if you see here, the word used here is shall, which means that if I am going for a common control merger and it's under Ind AS, I don't have an option. It is shall be done, right? The you have no other option but to go through this. I have not yet come across cases where people have applied to NCLT saying that, sorry, even though the standard says shall, can we interpret it as can for a particular case and go under the acquisition method? I have not seen any such thing happen yet in NCLT. And I don't know whether we can file something like this to NCLT and have NCLT look at it, because they are not experts in accounting. We are the experts in accounting, and whether such things can happen. But the word used here is shall. So if I am doing that, we need to be very, very clear in terms of that necessarily if the control is uncommon and it is demonstrable that there is common control, A, by the definition under Companies Act and then the definition under Ind AS, it pretty much aligns more or less. There are minor variations. I'm not getting into the nitty-gritties of it, but you will have to account for it under common control method. You have to go for pooling of interest method. You cannot go for acquisition method, right? So that has a huge impact. That has a huge impact on what a lot of transactions people have been doing, cases where they're doing a fair valuation, they're doing fair value of land and building, they're doing everything. But if it's a transaction under Ind AS, you cannot do it. It is shall be accounted using the pooling of interest method,
Maybe
right?
it's
The
worthwhile
assets
to
are
understand, what is the objective of using this method vis-a-vis the other methods?
so the objective is very simple. As I said, this comes from the background in economics, which talks about value, economic value. And here, when there is common control, the standards view it based on whatever is underlying theory, that I am taking from one pocket and putting it into another pocket. So when it's only a transfer of assets from one place to another, then I do not do it at the fair value, right? But I do it at the value which is internal to me, which is the cost of acquisition or the book value, historical cost or the book value which is represented, right? In some cases, it's historical cost. Some cases, it can be a measurement value as per Ind AS. But whatever may be the case, it should be as per the book value which is there in the balance sheets. Because it is moving from one pocket to another, I cannot use that opportunity. It cannot become a reason for me to start recognizing values which are not real or which cannot be realized, because it's not being realized at that point in time.
Yeah, you cannot
What you can
artificially. Yeah.
Sorry.
Yes, sir. So basically, it is like, you cannot artificially inflate the values and
Correct.
without, being able to unlock them.
Exactly, correct. And if you want to unlock that value or bring that value into the balance sheet, you have to go under the your property, plant and equipment standard, PPE standard, do the revaluation first and then merge it, right? Or do the merger and then revalue it, as may be the case, but you cannot artificially inflate it, right? You cannot do that. Yeah, the standards are very clear, and it's to avoid such circumstances. And to understand the real import of this has happened to me, where a person asked whether I can do it in fair value because of whatever XYZ reasons they personally had. And when we researched, how many ever times you read something you don't really recognize, because we say, yes, common control, we are using it differently. But when I took out the standard and read it, right, when they asked me this question, I realized it is shall and not can. And it is necessarily that it is shall and not can in those circumstances. So that transaction cannot happen, even if they want to manipulate it. Cannot happen. Please be very clear. This is why I said the accounting treatment is very important. If you have done a fair value exercise and you're going under Ind AS, if the wording is very clear, it is shall and not can. If you have given a fair value, you cannot do it. It has to be common control. It has to be accounted for using that manner, right? I have not come across a situation till now where, when I'm doing an Ind AS valuation, where we are using Ind AS and not accounting standard valuation, where a minority interest is adversely affected because of a common control transaction. As I said, there is a disparity between the intention of the accounting standards and the intention of uh, the valuation under Companies Act. One looks at public interest and other interests. The other looks at only the economic interest. The other being the valuation standards, they are worried only about the economic interest. They are not worried about the other interests. So in these circumstances, when there is a mismatch, if there is a loss to the minority shareholders, we need to think about a way in which they will be compensated. The other side of it is, it's very clear, as a person who controls, I am allowed to oppress the minority for my benefit is one of the ideas, because this is not a democracy. This is more a question of uh, majority controlling the minority which is there in a company. So are we allowed to oppress, and would that then be tantamount into something else? So how do we demonstrate this? These are dependent on case to case basis. I have not yet come across a case where we do this. Usually I test for the minority impact and advise the client based on the minority impact what needs to be done. We also carry out transactions through before the merger or during the merger itself to take care of the minority interest. For example, in one case, what I did was I did a fair valuation of the minority shares separately uh, for them to be bought out. we bought out the minority and then we did the merger under common control without any issue, because they were all family, or the remaining shareholders were all family, and we were able to get that family consensus, and then we went for a common control merger. But for the purpose of buying out the minority, we did a fair valuation exercise. We explained to them and we got it. We paid them a higher price beforehand itself, right? There you can either have the promoters buy the share individually if the capital gains involved will be low, or you can do a buyback, or if they intend to continue, you can explain to them in the long run you will be gaining even if you are going to lose in the short run, and you can do it. So these sort of options are available to us, right? So
Excuse me, if valuation of plant and machinery is done, then can we take the fair value versus
no,
merger?
no, it is very clear. It is common control. So it has to be assets and liabilities are combined to reflect their carrying amounts. Carrying amounts is nothing but the book value which is there, right? Book value
Even
is the
in case of
depreciation and
demerger?
amortization.
Even in case of demerger?
Yes, because in demerger, I'll be coming to demerger. It's basically an extension of the same concept. In a demerger also, if the same shareholder, so in a demerger, if the people who own the demerged company are the owners of the resultant company, if the shares are being issued to the same people, then there is common control, and you cannot go under any other method but to go by this, right? You will have to issue it at the uh, value. And usually in demerger, there is no question. We do it at book value, not because of accounting standards. We do it in book value because of income tax, because income tax is very clear. It has to be done at book value. If you don't do it at book value, you will not get the benefit of tax. You will not get the benefit of tax exemption. So it necessarily has to be at book value as per Income Tax Act, which I will come to next, right? So just to say, it is shell, and the assets and liabilities are reflected at their carrying amounts. No adjustments to reflect their fair values or recognize any new assets and liabilities. Only adjustments that are made to harmonize accounting policies, right? Only this is allowed, and nothing else is allowed. Uh, Prior periods shall be restated as if the business combination is occurred at the beginning of the preceding period and with the financial statements, irrespective of the actual date of combination. Has occurred after that date, prior information shall be restated only from that date. So I'm not worried about point 3. What is important for our purpose here is 1 and 2, that reflected at their carrying amounts and no fair valuation. Only to harmonize the accounting policies, we can change the value. Now, AS 14 looks at things differently. It allows the option. Having said this, if I'm doing for a company under where Ind AS is not applicable, pooling of interest method is allowed, right? If we have opted for pooling of interest, we can do. If we are opting for fair value, we can go under fair value. So here there is a disparity, if you see, in the sense that Ind AS does not allow the option, whereas here there is a certain sense of option available to us where we can choose whether we are doing pooling of interest or purchase method. Only thing, if you're going for pooling of, it's actually reverse. There, acquisition method is compulsory, and we have to, if there is common control, compulsorily we have to go for pooling of interest. Here, uh, pooling of interest is not compulsory, but if you're going to use pooling of interest, you will have to satisfy these conditions laid within the standard, right? These 5 conditions which are laid within. All assets and liabilities of the transferor company become, after amalgamation, the assets and liabilities of the transferring company, not less than 90%. So you're aware of these things, and intends to carry on the business of the transferor intends to be carried on after the amalgamation by the transferring company. So here there's a recognition of the going concern principle. There, if you see, there is no, there's no intention of whether you're going to do it or not. The test under Ind AS is very different. It is whether what I have bought is a business or not, right? If I've bought a business, then it has to be done under acquisition method. And if it's common control, common control. Here, purchase method and pooling of interest is only if I intend to carry on. One of the conditions I need to satisfy here is going concern, right? So there is a disparity in both. Uh, Obviously, for companies for which Ind AS is not applicable, we go under AS 14. Practically speaking, I try to look at the Ind AS logic more than AS 14 logic, because going ahead, that's what is going to be applicable. But if you're doing for smaller companies, this option is always available. That is why even if you're doing fair valuation for mergers, it is still being accepted because AS 14 allows us to do so. It will not be accepted if it is for an Ind AS case. So please be careful with that. My suggestion is where there is common control, always try to demonstrate the common control. Look at what I've told in terms of minority interest and go for the common control transaction. It is a much faster transaction to execute than for going for a fair value unless it is necessary for us to do it. So quickly, let's just look at income tax and then I'll get to the demerger part, cover demerger, and then I'll look at the questions. Now, all the amalgamation is quite straightforward. You know the definition. All properties immediately before become the properties after, liabilities before and after. Shareholders not less than 3/4 in value of the shareholding in the amalgamating company become shareholders of the amalgamated company by virtue of amalgamation. Uh, Otherwise, then a result of acquisition of property by pursuant to purchase of property, etc. So this is an important condition to satisfy the 3/4 rule. If you have done that, you get an exemption under Income Tax Act. Any transfer in a scheme of amalgamation of a asset, capital asset by the amalgamating company to the amalgamated company will be exempt. Any transfer in an Indian company, right? Foreign companies have a different rule. Any transfer in a scheme of amalgamation of a capital asset being share or shares held in an Indian company by the amalgamating foreign company to the amalgamated foreign company, if at least 25% of the shareholders of the amalgamating foreign company continue to remain shareholders. So this is for cross-border valuation. I'm not getting into this. Probably we can have a session later. I've also not done too many I have not actually done any cross-border valuation in the sense that for companies involved. But I have done recently. I've done for a case where a foreign company is holding shares in an Indian company, right? Those sort of cases I have done. But subsidiary, actually I've done one. Yeah, some time back I have done one, but not many. Yeah, any share in a scheme of amalgamation of capital asset paying shares of a foreign company, which derives directly or indirectly its value substantially from an Indian company held by the amalgamating foreign company, and same 25% rule applies. Importantly, transfer by the shareholder in a scheme of amalgamation of a capital asset. So these are the reasons why why we go for, actually speaking, this what is there under 47 is the main reason why we even go for this particular thing, and 72A, right? So amalgamated company holds 3/4 of the book value of assets for 5 years, right? And continues the business for 5 years. And such under conditions if given by central government and is for a genuine business purpose, right? So this is the crux of it. If you go back under here, common control, everything we have spoken about, there is no mention of going concern at all for a common control transaction. AS 14 recognizes going concern, but the reason why we always check for going concern, right, is this, that if the amalgamating company has losses, which is one of the reasons why a lot of these mergers actually take place within family concerns or even closely held companies, is that for taxation benefits, and you should hold the 3/4 of the assets for 5 years. It should be a continuous business and it should be done for a genuine business purpose. Going concern, genuine business purpose, and 3/4. Now, already 72A has enabled this genuine business purpose. This will further be tested under GAR, right? General Anti-Avoidance Regulation, where genuine business purpose will be tested more and more. So be ready if you're doing common control transactions or any of these transactions, demonstrate goodwill, going concern. If the going concern is not possible, then we need to reevaluate on the entire transaction and how we are going to show. Especially if they are losses, going concern becomes extremely important for the transaction, right? Income tax is very, very clear. As we go ahead, as the legislation improves, all the routes which are available to undervalue assets and transfer will be plugged. Whatever are remaining, whatever ingenious methods are being used will be plugged, which is the intention in terms of whether bringing money into the company or transferring shares or slum sale or any transactions we are doing. If there is an indirect transfer of value by undervaluing the properties or assets of a company or, let's say shares or land and building, etc., gold, etc., that will be plugged as we go forward in the next few years. And all these amendments which have been coming around valuation and income tax are all based on this idea that there should be no indirect transfer or a loss in or a transfer of value, right, at an undervalued way without a payment of tax.
Hello.
Right? Yeah.
Yeah. Into the previous slide, I just had one question. So
Yeah.
related to the type of the company where we are mentioning that it's an industrial hotel and in all those companies. So what I understand is the service sector is not covered here.
Yeah, correct. But software, we usually go into, we bring it in terms of undertaking, we do bring it into the definition, right? In terms of manufacturing of software, processing of goods or service, etc. We usually use this definition and to do it. It's an interesting question. Usually these are the things in terms of losses covered. If you are not able to fit it into this, we cannot take the losses.
So if the
You're right,
company
we
is
cannot take.
into IT services per se, that ITES or BPO or outsourcing services, then
Right.
the carry forward of loss is not allowed to them, as per the what I understand from this criteria.
Correct, correct. Yes. But again, there's manufacture of software available. So you're right. If it's pure IT thing, it will not. Yeah. Telecommunications, mining, construction, and ship or railways. You're right. Yeah.
And sir, on this amalgamating company, on the date, the 3/4 of the book value of the asset held for 2 years at least.
Yeah.
So what I understand is, for example, the transaction date is the 1st January 2024. So on that
Right.
date, whatever is the value of the asset I'm holding, for example, it is 1 CR, then the 75 lakh worth of asset should have been continued for more than 2 years, right?
Correct. Correct.
Okay.
The reason for all of these things is people have this tendency to form a vehicle. This is only for the benefit of carry forward and set of losses. We are not talking about the general merger. If we are only talking about profitable companies, this section does not apply. Uh, the idea is you should not form a vehicle to take the benefit of the losses from another company and misutilize it. So this is basically a provision, anti-abuse provision, which is there inbuilt in the act. So that is the idea which is behind under which this particular sections were framed, right? And it is also I think these are all due for amendments also, which I don't know at which point it will come. As rightly said, certain businesses are not allowed, right, in terms of whatever is an undertaking. I'm just, as we are speaking, I'm just cross-checking the definition. So where there has been an amalgamation of a company owning, let me just put up the definition. I hope you can see the definition instead of the slide now, right? If you see here, a company owning an industrial undertaking or a ship or a hotel, a banking company, one or more public sector companies or companies with public sector companies, erstwhile public sector companies, etc. And control will have the definition. See, please see this. Why I told you the important thing, the definition is important. Control shall have the same meaning assigned in 227 of Companies Act, which is what we saw directly, indirectly, etc., which was given there in concert or allow individually, etc. And yeah, so here it is very, very clear in terms of industrial undertaking, manufacture or processing of goods, manufacturing of computer software, electricity, uh, business of providing telecommunication services, basis or cellular, radio, satellite, networking or truncating, broadband network and internet services, mining, construction of ships, aircrafts or rails. Right. Other than this, nothing else is covered in this particular definition, right? So it's very important for us to cross check in terms of losses when it can be taken. Only if you are in one of these companies can you take set off and carry forward of losses. And as clearly mentioned here, been in business for 3 years, 3/4 of the book value of assets held for at least 2 years. Idea is these are anti-abuse provisions under Income Tax Act. And if we are not satisfied, if this is not satisfied, then there's a feeling. Now, what is here is very clear. It is not that it should be 1 crore as what was being pointed out. It isn't that the value of the assets is given. It is that what is the whatever is the assets I'm holding, 3/4 should have been brought in recently, right? Amalgamated company is in continuous business for 5 years and other such conditions for genuine business purpose. Okay, moving on. I'm not getting into the rule for lack of time because then that will drag on. I just want to then finally touch upon the valuation standards aspect of it. Now, I've gone by IBS and there are two options available One is synergetic value and equitable value. Now, and when we are doing mergers, very rarely do we go for market value. And please be careful whenever you're certifying, be very clear on the basis and premise of value you're using. For a lot of domestic transactions, especially under 62 of Companies Act, you need not, you are not looking at transactions happening at market value. You are probably looking at a valuation happening at equitable value or synergetic value. Correct? Where money is coming in from existing shareholders and it's not a rights issue. Certain other cases for non-cash consideration, etc. There may be reasons where it is not happening at fair value. It is happening either at equitable value or synergetic value. If it is that, you identify that in the valuation report clearly. You don't need to give fair value certificate, right? Fair value certificate is also a very high degree of, to say, simply put in India's language, it's a level 1 certification you're giving. So there are times when it's not possible for us to justify a level 1 certification. You can go for equitable value or synergetic value and demonstrate with documentation that why it is under one of those things, right? Now, for most of the common control transactions, it will come under equitable value, right? Which is that the price, estimated price for the transfer of an asset or liability between identified, knowledgeable and willing parties that reflect the respective interest of those parties. So when we're talking about a merger, right, the parties involved are the two companies and there is a common control. So very clearly there is a interest, special interest which is there, and it represents the price, estimated price for that transfer reflects their respective interest in the particular asset, right? So in that case, it is an equitable value and not a market value, correct? So we need to be very clear why we are under common control transactions. We are not certifying market value. We are certifying equitable value. I have given synergetic value here because for other mergers, right, where we might not be going under market value, it might be a higher valuation or there might be other considerations here of which will reflect the particular attributes of the asset that only the value specific purchaser will have, correct? Because I have a reason for a particular purchase or for me to buy something, I would be ready to pay a higher price because it is having something called a synergetic value. In those cases, I'll be ready to pay market value plus synergetic value, right? So the synergetic value can be greater than market value and it is allowed under the valuation standards. Now, for common control transactions, we will go under equitable value, right? So this is what we do under the basis of value will be. The premise of value will be not highest and best use because we are not looking at the highest and best use here. We are talking about the current use or existing use of the assets, right? And you see this current use may not necessarily, but also can be the highest and best use. So even if it is the highest and best use, you don't need to call it highest and best use when you're doing a common control transaction. You can call it as a current use or existing use. So the basis of value we use will be equitable value. The premise of value we use will be called current use or existing use. And the method we use will be the net asset method or the replacement or reproduction or whatever you want to call it. But the net asset method using book value under the cost approach, right? So finally, I'll quickly touch upon in 5 minutes on demerger, then we'll get to the questions. So demerger in relation to companies means the transfer pursuant to a scheme of arrangement under earlier 391, 394, here to 232, 232. By demerge of a company or one or more undertakings to any resulting company in a manner that all property of the undertaking being transferred immediately before the demerger become the property of the resulting company. All liabilities are moved. Property and liability of the undertakings being by the demerged company become the appear in the values in the books. So which is why I said demerger is a special case of book value transactions. And the reason for it to be book value is not because of India's or any of the standards, but one, yes, there is control demonstration, and we have to look at the fact that when there is common control, the value has to be done using book values. More importantly, for us to claim the tax benefits available for demerger to be seen as a tax neutral transaction, you necessarily need to do it only at book value. You cannot have a fair value or any revaluation done, right? You can revalue it for the purpose of accounting as given under Indian accounting standards. Resulting company issues in consideration shares to the shareholders of the demerged company on a proportionate basis, right? See, please be very clear. it has to be done on a proportionate basis. There cannot be a change in the ratio. The demerger consideration should be in the same proportion. Subsequent to the merger, if there is a family adjustment, I am going to take one division. The resultant company will have one division. The demerged company will have one division. Great. But do the demerger, issue the shares in the same ratio, then do a whatever gift settlement of the shares. That is allowed. But on the demerger, the consideration given has to be in the same proportion as in the demerged company. Otherwise, it will not be considered a tax neutral transaction. And most important thing, right? Yes, 3/4 of the value, etc., which is there, that rule applies here. But the most important thing here is the going concern. There are a lot of times where people come and ask us if we want, especially if there is any, they want to sell off an asset or do something where they want to demerge it, demerge the company and try and sell the asset or do something, work on some other sort of weird transaction. I don't want to get into the details, but we cannot certify in those cases because it will not satisfy the purpose of going concern, right? The business has to be a going concern. If it is not a going concern, there's no point in going for a demerger because the tax benefits are not available. You might as well directly sell the asset or figure out some other way to do the transaction. And yeah, this is the definition of the undertakings, etc. And one of the important things here is that the loans, whatever belong to the undertaking, have to move along with it. I have seen in a lot of cases, especially from advisory firms who are there. I don't want to mention names. You can call them big, small, whatever you want. I have seen that they don't fulfill the conditions because the transaction team is separate, tax team is separate. But this is basic knowledge. The entire demerger happens based on tax provision or reason to take care of the tax purposes, right? So you cannot have a differential thing. It has to go with the undertaking. So you have to define the undertaking clearly, show the business division undertaking clearly, and then segregate the assets. You cannot say, let's say, for example, I have a trading division and a manufacturing division. I cannot say that the 2/4 of the property, 2/5 of the property will go to the trading division. Trading division will have nothing. It will have only a small chart table and a fellow sitting there and doing some trading, right? Or whatever. I'm just being very reductionist there, but basically in terms of what happens. So property has to go with the division, with the manufacturing division where the plant and machinery are, where the building and plant and machinery are. There can be no weird division. Similarly, all creditors and all debtors have to be clearly identified and moved, right? Otherwise, it is not allowed. The only thing which practically where there will be a difference which doesn't move because of the demerger are the tax assets, in the sense that I'm not talking about losses. I'm talking about the advance tax paid, the TDS, because with TDS and advance tax, we cannot move it, right? Because it's locked to the PAN. It's difficult to move it. So we given the notes that because of XYZ reason, the tax asset is being left in this company. GST is separate. GST input credit, there's I think a provision available under GST Act where there's a process in the portal available where you can migrate the credit. That has to be migrated, right? So demergers tend to be very clearly common control transactions. And because of this virtue, almost 99% of demergers tend to be common control transactions. And being common control transactions, whatever we have discussed now is equally applicable to demergers, even though under normal circumstances, we might not think of it in that particular manner. And in this, once we are doing a demerger, all the benefits, the entire transaction and the shares issued, etc., are all exempt under 47. Right. So this is the background. So I think first I will take the questions under the chat box in the chat. Think there's a question on, can you please touch upon legal backing of mirror mergers where swap is 1:1, overriding needs of value? Can you explain that in detail, please? I'm not able to understand.
So actually, there are cases where companies simply say, "Ki this is we are a small company, India's is not applicable on us, but we as directors, we are all our family members. So we just simply putting out from one pocket and putting in another pocket. We're just basically merging everything, and we want valuation to be, we want swap ratio to be 1:1 only. So
Swap ratio cannot be 1:1 because the assets in the two companies will be different. It can be, see, if I am having 1 crore of assets in one company and I'm having 10 lakhs of assets in another company, let's say even assuming the share capital is the same, whatever, 10,000 shares. Obviously, the value of both the shares are different. So the swap ratio is calculated based on the value we arrive of these shares, right? So it cannot be a 1:1 swap ratio. It will be based on the value. And there is
So
a valuation required.
Just to
okay.
add here, I don't know how useful it is. We have done case of 1:1 where we have done a concept of mirror shareholding. There we have not used the swap ratio, but we have done it based on 1:1. But only if there is absolutely no leakage of economic rights, you can actually do that.
Correct.
But this is
Technically, from the valuation standards point of view, if what you're basically saying that a company A, company B, company has three share ABC, company B has XYZ. You're basically now doing ABC to XYZ in A and ABC to XYZ in B. Is that what you're saying?
yes.
Yes, yes.
Okay. So in those sort of cases, you can enter into you'll have to basically do it as fresh issue of shares, right? How would you bring it under 230, 232?
So so the idea is to maintain a mirror shareholding, and then we say that whatever for every share that you have in company A, if it's a new company that is getting formed for receiving this undertaking, we say company B will receive this undertaking, and it will be for every share you get allotted one share. But it is important to maintain a mirror shareholding, and if there are any up and down shareholding, what we ask is the tribunal has the right to cancel it, and we say as pursuant to the scheme, if you can cancel the shareholding in order to make it in line, but you should not have any external shareholders in anybody. It should be same mirror shareholding, and the receiving
Yeah,
entity have the same set of shareholders, no new shareholders that you have to manage it.
yeah, basically it's akin to a demerger. So you're doing it.
Okay.
I'll only say one thing in this front. See, NCLT will give you the order because it's a 230, 232. What you've said will go through that. But in the scheme document, another important aspect. So I talked about the accounting aspect. The other important aspect is the taxation aspect, right? Because the scheme also is also sent to the income tax department. Whenever you're doing any transactions, please include under the exemptions available under Income Tax Act. Test for the exemptions available under the Income Tax Act. If you're able to show it as a tax neutral transaction because of either the merger or demerger provisions we have discussed, then you're fine doing it. Otherwise, you have to check whether there's a taxation impact.
Got it. I have one query. Recently,
Yeah.
I come up with a demerger where we tried doing this kind of a 1:1. There was a minority
Right.
vote, which is like 0.1%, something akin to so very, very, very less minuscule. Otherwise, it was a complete shareholding. Now, the
Okay.
requirements on tax part of the demerger says that all the shareholders, pursuant to a consideration, are to be given shares in the company, in the resulting company. And the second one, it says at least 3/4 of the shareholders need to become should continue to be shareholders in the demerged company. Become the shareholders, not continue. Become shareholders in the demerging resulting company. Now, my
Correct.
query is that why is this kind of an anomaly that has been put out in law where it says the consideration is solely in the form of shares, and second, it says at least 3/4. It should be that everybody is guaranteed share, then everybody should become holder, right?
Correct. So everyone, because it's very clear, it should be in the demerge become on a proportionate basis, where the resulting company itself is a shareholder of the demerged company. So this is
This is the
also
only
allowed,
exception where
right?
it
So
has
there are
been.
two circumstances which are seen. One where the resulting company will hold 100%, right? And there anyway you will satisfy this 3/4 condition. See, there are also cases. What happens is, I'll tell you, this is something which I've also done. In a group, there'll be A, B, and C, three companies. B is a subsidiary of A, let us say. Now, B is being removed from A and sent to C. C will already have shareholders, right? Uh, Now, in those circumstances, right, not holding become shareholders of the resulting company by virtue of the demerger, there could be a reason why this 3/4 is broken when I'm transferring to C. So it is to avoid such scenario that they are bringing in this 3/4 rule, right? The shareholders holding not less than 3/4 of the values in the demerged company become shareholders of the resulting company or companies by virtue of demerger. There should be there are cases where some transactions happen where this could be broken, which is why they have brought this condition specifically. One thing in income taxes is everything is a reaction to something which has happened, right? All these amendments which have come, someone has been ingenious in using. It might not make sense under, say, the current act. It might have been something which was done under the old act, right? Or someone has done something under the old act. They are basically now. Useless to us, but these conditions are still carried, and we have to ensure that when we are undertaking the transaction, it is satisfied.
So the thing was, they were asking, can we do a minority settlement? But for me, all my rules are met with regard to undertaking, continuation, book value, everything is met, except this minority of 0.1% had to be settled in cash. That is the only requirement. Now,
Right.
I'm still complying with all the other conditions. So I am not able to find any case laws or any other support except for interpreting the act. So any thoughts
Uh,
on?
you can buy the shares out of the minority before the transaction, and usually when you are settling a minority, it has to be done at fair value. You can either do a private buyout, or you can do a buyback in the
Estimate is
company
only
and
at
then
fair value.
remove the
We
minority.
have estimated is part of the fair value and given it as part of the scheme. So is there likely to be any sort of an anomaly? They don't want to settle it out. So I'm not too sure. I'm just
Mm.
No,
You
getting.
can
my
you can do that. See, we usually do that in a merger transaction because merger transaction covers that. I have to explore this because I have not done this in a demerger transaction. I have done this in a merger transaction where whatever 235 or whatever allows us to buy out a minority. So that is allowed under merger. And because it's allowed over there, I think even for a demerger, we can find a way to ask for that in the petition. So that should not be a problem. But from a taxation perspective, I have to explore this further.
Okay, fine, great. Thank you so much.
No, I think we can
Actually,
do like a composite scheme. So either maybe with the merger with the capital reduction scheme. So with that, so in the capital reduction, so these minority shareholders you can buy back.
Uh,
Yeah,
uh,
So something,
235 to 235 is
yeah,
also there, sir. Even under 235, you
yeah,
can specifically buy out minority also. That option is there.
that option
So
is there. So
that is
normally,
actually,
yeah,
yes,
okay.
actually,
not
funnily enough, in that option we used, but
yeah.
I had not seen any case come across. We had done everything was successful, but that was the case where there was a mistake in the the scheme document, and the court said you come from the beginning. So we decided
Oh,
the time it took to do the scheme and everything, the company didn't want to go back under this. They wanted to do a different route. So we are now doing a different route. See,
no, that's what.
there are a lot of interesting things I do.
Yeah.
Unfortunately, somewhere someone else makes a mistake and then
So
the
tell me
scheme
about
is
it.
not approved. I can't give the details and share that as a case. Even though the valuation is perfect, it has been approved. I am stuck in 2, 3 cases like this where the work done is really nice, but unfortunately, because of some other issue, the valuation is stuck. The valuation was approved, cleared by all the authorities, everything. Even in the other case, I was telling you, yeah, even the exchanges have cleared the transaction, but I am not able to use that as a case because of the other inherent issues, and because it was not used, I don't want to discuss it. Somewhere some
Yeah,
value,
fine.
because these are all shares, right? It's somewhere
Yeah.
I shouldn't disclose something which someone else might
Yeah.
have an interest in an asset. If it's public information, I can disclose, but if it's not, I shouldn't disclose. That's a problem.
So generally,
So that's what.
as a scheme of
Uh,
things, says no. What is meant to be is meant to be. So we generally leave it as part of the karmic cycle.
no,
Yeah,
no,
everything
actually,
we have to become philosophical.
no, actually, we did two transactions like this. So to just get away from this minority shareholder, so we did composite scheme. So
Okay.
that one kind of a restructuring we can think of.
Yes.
What of the for Maithili, what she discussed. So with that, we can just
Yes.
buy from the minority shareholders and just close the transaction, and they
Yes.
will become a 100% in future. But only one
Yes.
small clarification.
Yeah.
When this it will trigger is a common control transaction. See, for example, 95% is holding by the holding company and 5% is the subsidiary company if it is holding. Still, we can do a common control transaction,
Yes.
but using the book value method, or is it a fair value method?
Book value method.
So, but see, the 5% it is a external shareholder. It is not invested by the holding company. It is invested by the subsidiary companies, other subsidiary companies.
Subsidiary is also ultimately held by the holding company, but the
So from
threshold
the
under Companies Act for control is 50%, more than 50%. Sorry. So if you are crossing that itself, you can start going under common control. The only caveat which I had was the fact that minority should not be adversely affected.
Yeah. Okay. So, but see, generally what we are seeing is 99.99% and 0.01%. Still, we can go use this method. But
Yes.
from an accounting perspective, if you see Ind AS 103, so it will be again on a fair value basis, right?
No.
So
Second, we
there
are
also it
under,
is.
see, the,
Yeah.
yeah, what 103 says is very clear. Second, there is common control. It shall be only on pooling of interest at book value.
Oh, again, it is a book value. So resultant value will
Yes.
not be any goodwill, no impairment in future, no work for us.
Nothing. Correct. Yes. That is why we are going under this.
But
Okay.
under
So, but
accounting standard, we can take a fair market value, sir.
pardon?
Sorry?
Yes. Under AS 14 for demerger, can we take a
Yeah.
fair value?
No, demerger, we don't go under fair value simply because of income tax. Because income tax says very clearly you have to do it at book value for the tax benefits. So there is usually demerger is being done specifically for claiming the tax benefits. So that is why if you see,
Okay.
even for merger, the conditions given under income tax are very little. But if you say demerger, it goes on and on and on in terms of what you need to do because of the fact that usually it is seen as a provision which is abused by people to transfer assets to outsiders.
But
So that's why there are very strict conditions on demergers.
okay. So, but if you going through the share purchase agreement, so then it will be we have to do a fair value only, right? There is no other
Which
choice
share
for us.
purchase?
No, if
Which
it
share
is
purchase
through
agreement, sir?
share purchase agreement, not through a merger route, not through
Right.
NCLT route,
Yeah,
not
yeah.
through RD route. So in that case, only we
Right.
have a only choice is that fair value.
So again, what the
Yeah.
accounting standards look at is very
Yeah.
clear. Sorry, valuation standards look at, right?
Yeah.
Equitable value is when there is a special interest which only the
Mhm.
parties involved in the assets know. So if there are
Okay.
cases where a party is already involved in the asset, right, which is in the business or a shareholder of one of the companies or both the companies, and they have information and they have special interest in it, then we can go under equitable value. And when we are going under equitable value, we can always do it under current or existing use, which can be book value, right? Or it
Oh.
can be fair value of only properties. It depends on case to case basis. So it is not that I have to go only for fair value. There are cases where we can do other things. The only rider is if it's a FEMA case, then we have to go only under fair value.
Okay. Yeah, majority in what we are undertaking in the Bangalore. So majority it will be a foreign investors. So in a way, this FEMA will trigger the pricing guidelines will
Correct.
trigger indirectly.
Correct.
So
Correct.
okay.
Correct.
Got it. Got it. Thanks.
For demergers, we don't need any valuation report itself, is it?
We need.
But you're saying we have to do it at book value.
Yeah, we have to do it at book value, but the report has to be given.
It is
Because
the
the assets
valuer's
and liabilities have to
judgment.
be edited. There is a division. So ideally, what happens in a demerger, the company identifies the undertaking to be demerged or the business to be demerged, and they give the net assets. So we take both the net assets and we arrive at the value. While as simple as it sounds, usually companies are very bad at identifying these particular assets. I get some very bad looking assets are not properly classified. Debtors and creditors are not properly divided. Suppose there are two plants and the plants are now being divided as two separate companies. Both the plants would have supplied to the same person. That will reflect as one single debtor. But now that has to be divided. So there's a lot of work done to be done in the sense that we have to sit with the company and explain how the assets have to be, go through all the assets and check with them whether it has all been divided properly. Because if it is not done, as we have already seen in income under the income tax provisions, if the assets and liabilities don't move along with the division, including the loans and including the debtors, creditors, it will not be considered as a demerger for the purpose of income tax.
Here, Vishesh, when demerger happens and there is a mirror shareholding pattern, okay, there is no loss of economic interest for anyone, okay, and the bigger company say has a paid up capital of 10 lakh and the small demerged entity is going to be say 1 lakh. Is there a, I have read this target capital method wherein there is no, only relative valuation is done and not an absolute value, and target capital structure. So 10 lakh and 1 lakh, I just give a swap ratio of 10:1 and justify why I'm giving a relative value, target capital, mirror imaging, no loss of control. Is that permitted?
Yes. Yeah, that is fine because usually that is what we do because the remaining amount will go to the reserves. So one is the capital, but actually what is being transferred is the net assets. So if my net asset value is say let's say 10 crores. If my capital is 1 lakh, the remaining amount go asset minus liability. If it's 10 crores, 1 lakh is in the thing. The remaining amount goes to the reserves, right? And the ratio will still be the same. So there is no value loss. It is still in the same proportion. So that is allowed. And even income tax doesn't have say anything about, it should not go to reserves. Everything should be in capital, etc. Nothing. There's no such thing even in income tax. Only conditions is the number of shares you're holding and the percentage of shareholding and the control which is there, right? So it can go to reserves. That's not a problem. Usually that is what will happen because practically if you're removing 10 crores of assets from the other balance sheet, the adjustment will happen in the reserves, not in the capital. The capital will still remain 1 crore. The differential adjustment will be in the reserves. So that reserves will move here. Or if you want to
Sir,
have a higher capital and lesser reserves also, that's fine. I don't see a problem with that.
sir, in case of immovable properties,
Yes.
the valuation, the current valuation is to be considered, no?
No need, sir. If under a common control transaction, we can do it at book value. Only for the stamp duty purpose, they will value it as per the guideline value and you have to pay it on that. Whatever is the
But in
percentage in that particular state for that.
under 11 UA, that adjustment is required to be given.
But merger and for mergers and demergers, 11 UA is not applicable because it is a special process under NCLT. 11 UA is
Okay.
applicable only for 56 27B and 50 CA. And a couple of other places where there are references, but not another, but not for these sections, not for merger and demerger.
So common control means you mean identical shareholding, or even if there is a variance in shareholding, number of shares, the same shareholders will be there.
Correct.
No, you mean to say identical shareholding?
No, even where it can be even variable.
No, if there is
It
a
is
variance,
that the same shareholders.
allotment. See, even if there is a variance, by somebody, see, a company A would have purchased the asset in 1985, another one maybe in 2000. So you and shareholding, there will be common shareholders, obviously. Okay,
Correct.
common control.
Correct.
But then there will be disproportionate allotment if you are not going to value at the fair market value, rather guideline value, whatever. Isn't it?
Correct.
Value
So
can
what we do
also
in
be
that's
considered.
correct. So what we do in those circumstances is why I said the important part in terms of documentation. Usually this common control is within family, right? Invariably in Indian context, it means that it's within the same family. So precisely what happens is we get a resolution or we get a letter from all of them that this is the difference and I'm fine with this particular shareholding structure and keep it, so that they are taking an informed economic decision on giving up certain things because the merger has other benefits. So even if they are giving up, even if there's a minor adjustment in value because of the merger, they are ready to go ahead with it because there are long-term benefits which will outweigh the whatever sacrifice or anything which even might arise indirectly. So that's why I said it's important to ensure the documentation is perfect and the minority interest is taken care of. In what you are saying, if there's an adverse impact on the minority and the minority refuses to sacrifice, then we have to accommodate that only through a fair valuation or through some other way, buyback of the minority on a fair value or some other method, and only then do the merger. Otherwise, we cannot go for it.
But per se, there is nothing wrong in going into fair value or even the guideline value as 11 UA would advise, isn't it?
It's not a question of whether there is wrong. If you are doing a valuation under Ind AS, where Ind AS is applicable, it is very clear. Common control will be a shall. So that is where the catch comes, right? So this has not yet been tested because we are going, the principles are just being applied and transactions are flowing. And on top of this Ind AS requirement, there's also SEBI requirements. So when a lot of cases with where Ind AS is applicable are listed entities, over there we go by what SEBI says. SEBI has recently come out with a basically a guideline where you have to say which are the methods you have used, what is the value under each of the method, or give justification why you have not used one of the methods, use the latest balance sheet within the last 3 months, etc. A lot of new amendments have come in SEBI regulations also. So we have to study, if it's a listed entity valuation where India is mostly will be applicable, you have to study the SEBI requirements, their pricing guide, their valuation requirements, especially for private companies, non-listed companies and infrequently traded companies, etc., and go by that.
Okay. Thank you.
Due to constraint of time, Vishesh, I request you to take the questions as per the chat, and then
Okay.
we will not be able
Okay.
to take up new queries.
Okay. I think there's a detailed case in the chat. I hope it brief note. Company A Private Limited is a 100% holding company of B. C Limited, both are wholly owned and has invested. Okay. Getting amalgamated with C. Okay. Can this be done under the? Yeah, it can be done under the fast track merger. It's wholly owned subsidiaries, right? So it can be done. There is no issue with that. Can you please demonstrate exist with the help of an example? Does it consist of related parties? So demonstration of common control. See, anything which falls within the definition of common control over here will come under the common control transaction. Example, does it consist of related parties? Yes, in the sense that the two companies would have, you would find them in the related party disclosures in the balance sheets, right? You would find that they are. It can also be that the same shareholders are there in both the companies. Family, let's say ABC are three individuals of the same family. They control A, they control B. They needn't be of the same family. They can be friends. They can be anybody. ABC control two companies. In essence, let's say it's the same 100% held by three, but there's minor variation in the percentage. They want to do a common control merger. They can do a common control merger because they are doing it. If it is under Ind AS, it will necessarily go under common control. Right. So that is where I said if there is a sacrifice or if there is plus or minus on one side, in a merger, there are considerations other than just the economic value. There will be, I mean, in the sense that the current value of assets, there'll be future economic value also under consideration. Synergy benefits would be there. So because of those considerations, one party might be ready to sacrifice because of the ease of operations, etc. Or if we find that the value loss is very high, we have to work it out. Then we have to come out with a way to ensure that all of them feel compensated correctly, right? So these are the things which we have to look at.
Sorry to interrupt, Visheh. The previous question was mine. What happened
Yes,
is when there is a wholly owned subsidiary of a wholly owned subsidiary, is not a small company. So
okay.
that is where we had the challenge. Actually, I thought whether anyone has done it or ROC has
Okay.
accepted it.
Okay. I haven't done this, but if anyone else has done that, I think they can answer that. Basically, there are two wholly owned subsidiary, two wholly owned
Two wholly owned
subsidiaries.
subsidiaries are getting merged. So that is where the problem is. They are not small companies.
Right.
So that we are in doubt
I
actually
think
what to
it's
do.
possible, sir. They did through a fast track merger when it was a wholly owned subsidiary. But I am talking for a case which was done like 5 years back. But it went through, sir, with a fast track merger, and I think it goes through the RD route, right, rather than the NCLT route.
Yeah, RD route, but both are not small companies because of subsidiary. Anyhow, if you are
No,
saying
for small company, no, there is a threshold has been defined in the fast track merger. Only if you are satisfied that condition, then only we can route it through a RD. Otherwise, they will not accept. So you have to go through a NCLT route only. So those conditions has been clearly defined because we have gone. First we decided we'll go for NCLT, one of the case. Then we decided later the fastest route is the RD route. So NCLT, it is happening nowadays. It is a 2 years minimum. All my cases, it is almost all closed by more than 2 years. But in RD, we are just closed within 1 year. So check those conditions. I think there is a small. They define clearly some of the criteria.
Thanks.
I don't see here where because both are not small companies. The act is saying only between two or more small companies or between a holding company and its wholly owned subsidiary company. Right. So I don't see a case where two wholly owned subsidiaries can be done on the same basis. It should be a common control transaction, yes, but so there won't be a particularly any great valuation report in the sense that it will be only the same ratio, whatever will be there. Because there's a see, even though it's the same person, the shares are going to be merged. Still, a valuation will be there, and RD. I don't think RD route will be allowed. That's what I
The
was
book
just want to
value
check.
should be used, is it?
You can use the book value. You can use book value, but I don't think it will come under the RD. Okay.
Thank you.
And I think the definition. Yeah, I think this
So would
we
it
have
make
already
sense to
discussed.
kind of reduce the share capital and bring it, make it a small company and then do the fast track scheme?
Yeah. If it is worthwhile doing it and if it is possible to do it, we can do it. A lot of times we try to do other minor transactions to see if we can bring it under any of these faster routes. Right? There are share transfers also we do. There are buybacks we do. We do a lot of things to try and bring that. As I said, even for the other case where there's a minority, first thing which we recommend is you try and buy the shares out privately. If they are owning 0.01% or something, doesn't make sense for them to bring them in the scheme and disclose everything and do it. You try and finish it privately also if possible. There's a small tax outflow or something, it doesn't matter because the cost of trying to answer questions will be more than trying to pay a small amount of tax. So these maximizations can be done. Okay. What happens in case of instruments considered allotted as consideration in the case of a demerger? What would be the valuation requirements? See, as far as demerger is concerned, only thing is they have to become shareholders in the same proportion. Whatever adjustments are within the reserves, right, or in terms of say preference or debentures, etc., are allowed because this is on the net assets is the same. It's to be done at book value. The consideration is in the form of equity shares, right? Is in the form of shares which are being issued. Now, as long as you're satisfying the conditions under Income Tax Act, you will get the tax benefit. If you're breaking that, other things are allowed under Companies Act. But if your intention is for the tax benefit, you have to go by that. Under Companies Act, all these preferences, debentures, all of these things are allowed. There's nothing which stops that. Under Income Tax Act, you have to ensure that you are fulfilling the conditions laid therein. If you're satisfying that, there is no problem.
No, actually, I will extend the query a little bit. If there is a complex cap table, okay, which is in transfer or company or in one company, and while issuing the valuation report, how should the swap ratio be given?
Okay.
That
so,
also,
for example, okay. So, if the debentures are related to the undertaking which is being demerged, then that debenture also has to be moved.
With the same.
Yes.
We have
It
to
has to be.
create a mirror to cap table and then give a swap ratio
No,
accordingly.
If it's a debenture, I'm assuming this is not a compulsory debenture, convertible debenture. It's a vanilla debenture, non-convertible debenture. Non-convertible debenture is a liability, and as we have to move the liability along with the assets associated with it.
So the valuer has to give swap ratio for each of the.
Correct. Yeah, it has to be moved in the net asset. Yes. So if it is of the demerged entity, then, or if it's of the resultant company, then it has to be moved to the resultant company. If it's of the demerged company, it has to remain in the same balance sheet. So all the liabilities associated with the assets or the undertaking have to move along with that particular group of assets.
Now the question what Shilpa is raising. So if you in the capital structure is having the equity, CCPS and CCDs like that, if it is there, then share exchange ratio has to be given at a multiple based on the capital structure wise. So that's what she was asking. So in the merger scenario, so whenever the swap ratio we are considering, so we have to give based on the capital structure. So I think we have to specifically spell out this one. These many shares for equity, these many shares for OCPS, these many shares for CCPS. So like that, we have to conclude in the share exchange ratio. I think so.
Yeah. Correct. Yeah.
Correct, Shilpa. That is what your question.
Correct.
So you have to specifically spell out in the share exchange ratio. But how we are going to value is a different basis. So that is again, it is a different methodology. Whatever it is, that based on the terms of the agreement, what they're going to. Okay, at the time of issue.
Talk on OCPS and things like that, OCDs and OCPS, right? I nowadays I advise clients not to go into this optionality at all. You either do it compulsorily convertible or non-convertible. You don't have doubts in life, right? You can have personally, you have whatever doubts you have, you keep it to yourself. Don't have doubts in terms of these things because it's getting incredibly difficult. We don't know how the taxation is going to go on these things, right? So it's better to avoid ambiguity. See, if it's a very large company which has its own philosophy and mind, etc., those are separate. For all the small companies we are dealing with, don't be uncertain. Be certain on whether you want it to be convertible or not convertible. If you want to give equity and you want to delay the equity, do CCD, CCPS, it's okay. If you don't want that person to be related to equity, don't do. Be very clear in your intention on what you're taking. Like have clarity. This optionality and other things are great for large companies, but for small companies, because see, we don't know how the taxation is going to go or how it's going to be interpreted down the line. then why have the ambiguity? If there is a claim on tax, or if there is some other issue which props up, it's disproportionate in dealing with. So having a clarity today is better than for whatever. If they disagree, then I say, okay, we will see later. We will give you the advice. You see later what happens. Don't ask me if something goes wrong, right? So we can only give the advice, but lot of clients today are agreeing, and especially with CCDs, if it's a domestic CCD, we don't need to. We can leave it open ended and say it will be done on a converted at a valuation later on, right? And we can have that open endedness, because we are not able to arrive at a valuation today of the company because of too many factors. Especially if it's just coming up, it's an upcoming company. A lot of issues are there, right? It gets very difficult to value the company on a certain basis. Just so many conditions, because for any valuation, I have to go to a merchant banker now under income tax if it's a new company, because of DCF has to be certified by a merchant banker. Too many reports are there, so many things are circulating. It's very difficult to keep track of what is happening ultimately.
Yes,
Okay. Yes.
we would like to conclude today's session. I request Sagar Shah to come on video. Mr. Sagar Shah?
Yeah.
Yeah.
Yeah. Thank you, sir.
Yeah, I would like to request Mr. Sagar Shah to extend formal vote of thanks on behalf of Bangalore Valuers Association.
Yeah.
And before this, one small announcement. Bangalore Valuers Association membership is due. I request all the members here who are participating to renew and avail a 20% discount on the membership fees. And I request all the non-members to please use this discount and go ahead and become our member. And over to you, Mr. Sagar.
Yeah, thank you, Shilpa. On behalf of the Bangalore Valuation Association, I would like to express my gratitude towards Mr. Visheh for enlightening us, all the members, on the important topic of mergers, acquisition, and demergers, and covering the 360-degree aspects, not only the valuation as well as the accounting and all the complex stuff which we all need to take care while doing the valuation. And he has rightly shared his insight that while we are the valuers, but we should not only look at the valuation, we should also understand the accounting principle, and also we should learn how the scheme is drafted and what all the implication would have been on the valuation aspect, which we should take care while doing the fair valuation of these mergers and acquisitions. And I would also like to appreciate all the members who have taken their active participation and active listening, and have spent their insightful time on Saturday morning to learn this important topic from the respectful member, Mr. Visheh. Thank you once again, and we would like to have this interesting session in the future also on behalf of Bangalore Valuation. Thank you.
Thank you, everyone. It was nice to be participate with again, take a session at Bangalore Valuers Association. I'm looking forward to interacting more. This is one of the forums where I had told Shilpa ma'am earlier also. Lot of sessions where we take people, everyone switches off the camera. There is nobody on the other side. You think you're talking to yourself for 2-3 hours. So it is great to have interaction and deliberations. It's always necessary as professionals to keep meeting others and talk. Only then we get new ideas. We also encounter new cases and learn. So thank you for having me. It's been a great time spending today morning with all of you.
Yeah, thank you, Visheh. We shall courier you the memento which is being shared on the screen. Our admin will be in touch with you.
Thank you. Thank you.
Thank you, everyone. Have a happy weekend.
Nice day. Thank you. Thank you.
Vijay, you can stop the recording.
Thank you.